Hello, everyone, and welcome back to a new episode of In the Spotlight, a podcast by Aditya Birla Capital, where we bring to you interesting insights from our experts on loans, investments, insurance, and payments. And I am your host, Darshana Shah. In India today, life insurance is more than just a safety net for your family, it's a key component of retirement planning. It helps in providing financial stability for your golden years, and it's especially important for millennials, Gen Z, and women to start early given their unique financial challenges and opportunities. Today, we have a special guest, Mr. Kamlesh Rao, MD and CEO of our very own Aditya Birla Sun Life Insurance, and he will share valuable insights on this topic. Welcome, Kamlesh, to In the Spotlight. Very happy to have you here.
Thank you.
And Kamlesh, since I know that you are almost now three decades plus in BFSI and recently for many years in life insurance, so tell me, how has your journey been in this category called life insurance?
When I got to life insurance with like 25 years of experience in financial services, life insurance got humility in me back all over again. I was like a student or a learner again in financial services.
Wow.
And I must admit that I haven't managed anything more comprehensively complicated than life insurance in my first 25 years.
Yeah, I can see the excitement and the passion. But the category still, in spite of people like you coming and putting a lot of passion, and yes, things are changing, it's still less than 4% penetrated. And it's still a term plan as a category. So, what is changing over the years? And how can consumers and the younger ones adopt and buy more into life insurance?
I think life insurance has two fundamental problems. One is, I think the number of people that we cover, in the sense people who buy insurance, is not that great. In terms of GDP, it will still shows about 3%, 3.2%, which is comparable to a lot of countries. Maybe some places like Malaysia, Singapore will be significantly higher, but we are comparable. But for the size of the consumption population that we have a lot of scope from that point of view. So, like I said, lesser people are insured. But to me, the bigger problem is the people who are insured are not insured enough. And unlike the question that you said, it's all about protection.
Yes.
I'm not sure because it's all about protection, because on statistics, I can tell you last year, for entire industry, if it paid out 100 rupees, we paid about 9 rupees for death.
Oh, but I think then the perception is different from reality.
Yeah, the balance 91 rupees we actually paid to people who were living.
Wow.
So which basically means that we now are a reasonable allocation in your asset allocation that you do for savings. And that's where the 91% of the money actually got paid out.
And you brought in another interesting, life segment, which is retirement. And Kamlesh, this is where we will spend a little more time to understand that today, when you talk to millennials and Gen Zs, the way they come in, they've already planned. And I'm sure, I hear this from my son, who's also a Gen Z, that, I just want to work for so many years and I want to retire and enjoy life. They want life experiences. So what would you tell these audiences that when they're coming in the category, I know a lot of people buy for tax savings, life insurance plans, but what about retirement? What is your take on that?
So I think if you look at the way the country is moving into a new tax regime over the last 2 or 3 years, nothing will be left which will give you a tax benefit per se. If you look at tax regime, all the benefits are going away. And over the last 3 or 4 years, I have seen not many people buying it from a tax point of view. They think they want to have a certain amount of asset allocation. I get asked this question at forums where, there are people who want to retire at 40 and people who want to retire at early ages.
Absolutely.
And somebody asked me this question, whether it's a myth or a reality. I still think for being able to retire at 40, maybe, 1% or 0.5% of people, we will be able to manage that. Fundamentally, we are all going to live longer.
Yes.
Because average age is going up. Medical costs are not going down. The inflation of medical costs is roughly about 12 to 15% every year. And I have this fundamental belief that people think that wealth is what they need to create for retirement. Okay, I'll give you an example. I call it the uh, cost to income ratio when you are earning. So you're earning X amount of money and then there are costs, right?
Correct.
Uh, I've always been a great advocate to say whatever is your cost, assuming your cost is 90% of what you earn. Everybody complains, and the Gen Zs that you talk about, they want to spend more than
Yeah,
what they
more
earn in the first
experience.
place. I have a son of 24 and I get worried about that. But I've always said whatever you save doesn't matter, whether it's 5%, 7%, 10%, 20%. You got to find an investment discipline because in early school they taught us mathematics, and they taught us simple interest and compound interest. Yeah, I think the power of compound interest is ridiculously amazing, and I don't think people understand that. Somebody says my income goes up by X percentage. Even if it goes up by 5%, it doubles in 15 years time. If it goes up by 10, then I'm saying it can double much earlier. If you are lucky and goes up by 25, then you can double in 3 years time.
Absolutely.
I don't know which category people will belong to, but the power of compounding is so amazing that you need to start early to be able to make sure that when you retire, and I still think 40 is a myth. So let's say that you have to retire at 60, 55, 60, whatever that age is. The earlier you start, I think the better is the opportunity for being able to do that. But it's easier said, right? I mean, at 30, you are bothered about the first car that you want to buy, so you want to pay off your car loan. Maybe at 35, you're buying a house, so you're worried about paying off your home loan.
True.
And therefore, I think even at 45, if you have started thinking about your retirement, it's not a bad starting point. And
Is it?
It's not a bad starting point at all. I was at a conference of some affluent people of whatever, 40, above 40, or some concept like that. And I was telling them, guys, and they were talking about what will they leave behind. Yeah, so here is this thing that you first worry about car, then worry about your home loan. By the time you've just finished that at 45, 50, you're worried about what you leave behind. And I said, well, you have a life between 60 and 80.
Correct.
Now that I think is not on top of mind of a lot of people, that you will live between 60 and 80. Hopefully, as you progress in your life, between 45 and 55 is the best phase of your life. You'll live life in a reasonable style. You have to be able to do that between 60 and 80. Why worry about what will you leave behind? My principle is whatever is left you leave behind is fine. Don't worry about what will you leave behind. And therefore, if you start even at 45, 45, 46, 47, and you give it about 10, 12 years, because that's the only investment that you can make, which you don't need to get anything immediately. And that's where the power of compounding works. That you put aside money for 10, 12, 15, 20 years if you start at 40 or 45. And then the power of that is amazing. And of course, life insurance has got some really great solutions to take care of that.
So what I'm hearing is that you have broken first the myth that, oh my God, at 40 you cannot retire, no matter how much you wish. 45 is a good start, because I'm assuming that's when you have a little bit more money, and that's where the larger the amount you're putting in, the compounding is better.
Yes.
So that now brings me to closer home in Aditya Birla Capital at Aditya Birla Sun Life Insurance. Tell me what kind of products that we have for retirement solutions.
You have a range of products. You have products which you can invest for, and I started about 48. So I had about 12 years and said, give myself 12 years. And I said, if I plan that in 2 or 3 products. One which gives me post 60, it gives me a cash flow for the next 10 years. So the quantum of that. So if I had 100 rupees investable surplus to put for my annuity, then I said I'll break it up into 33, 33, 33. One which gives me a better cash flow, because I have invested for 12 years time frame, and then it pays me over the next 10 years time frame. But it pays me reasonable amount of money because the investing period is 12 and the return that the life insurance company is giving me is for 10 years. So my cash flow has gone up for 10 years time. The next 33 is for 20 years and the last 33 is for whole life.
Okay.
I don't know till when I will live. So if you break up into products like these, and each of these products are on guaranteed savings platforms.
But is this better percentage or better returns than a fixed deposit that you will see a lot of, people 40, 45 plus who believe in the erstwhile, or you can say the conventional or traditional instruments of saving? Are the returns better?
See, I'm not a great fan of fixed deposits because I think there's a concept called real interest rate. Remember,
Okay.
in a country that where we live, 5% is inflation. So if you get a 5% return, you are not getting anything because its money has remained at the same level
Absolutely.
after that point of time. So bulk of fixed deposit would be in that rate. It will get taxed at your
Correct.
earning rate. So I'm saying your net rate will be significantly lower. Fortunately for insurance, you also get a tax break. And remember, this is the only category which tells you that whilst you are planning for living, if something goes wrong with you, then there are products which give you minimum 10 times of what premium you have paid as your death benefit. Yeah, so you are say 30, 32, 33, and you got a first kid. All of us now want to, invest in kids' education and so on and so
Absolutely.
forth, and those are not cheap. Some of the beauty of the life insurance products is that you start investing, you don't get any benefit. You get the benefit at, again, point of time of 15 years, 18 years, 21 years. Again, the compounding benefit kind of kicks in here because you are
Correct.
investing and getting benefits post facto. It also has a feature that if something happens to you, you have what you call a waiver of premium benefit, which basically means that you have paid only 5 premiums, but I told you if you paid 10 premiums, then I'll give you this benefit at year 15, year 18, and year 21 of your child. The product is constructed in such a fashion that even if you paid 5 and something happens to you, the benefit that we promised will be paid to the child, and actually the balance premiums will be paid by the life insurance company.
Wow, that's a Santa Claus feeling already. So, what I really understand is that whilst you are planning for your life goals, is where you are actually taking life insurance, and you, whether it's your child's education, whether it is marriage, or whether it's your retirement, and you get the compounding interest, you get the interest like we spoke on the retirement product, we get 6% plus, returns coming in, and beyond that, if something happens, there is a waiver or there's the whole term plan kick in where the death benefit kicks
The
in.
death benefit kicks in.
I think that is brilliant journey for people who are listening, and they should definitely look at investing in life insurance. And Kamlesh, what is really interesting is what I saw your new campaign, and what I really like the take that when people say कि आप बड़े होके क्या बनोगे, and the entire reverse take which said कि आप बूढ़े होके क्या बनोगे. Can you throw light on that insight and what inspired you all, because that's really interesting.
Between 2030 and 2050, India's 60 plus population is going to double from where it is today. And one of the primary reasons India may not remain a
Yes.
as much younger country as it has been because, I had 3 brothers and 1 sister. I have only 1 kid. My kid, I don't know whether we'll have a kid, we'll get married, and the social thinking process is changing.
Correct.
And therefore, the aging population is going at a very fast pace. And therefore, we got this insight to say, if people are not planning for their retirement, how do you kind of shake these guys up and say between 45 years to start thinking? Because a lot of them come close to about 58, 59 and say, what do I do? And I'm not saying we are the only instrument. Okay, I'm saying you could do mutual fund SIPs for sure. People believe in putting money in equity. But I'm a firm believer that wealth is never a replacement for your living. Cash flow is more important than wealth. Yeah? So you think you have a portfolio of stocks, okay? And you think you made, say, 1 crore in that. But there was a time when COVID happened where that 1 crore would have become 25 lakhs.
Yeah, absolutely.
So wealth is unpredictable. Your retirement solutions, when you are living, is a function of your cash flow. And therefore, cash flow creation is extremely important. So to shake these guys, he said, I've been part of this to constantly ask my son, what do you want to become? And I thought it was a great idea to flip it around for these guys to ask their parents, कि आप बूढ़े होके क्या बनोगे? You may want to believe that you will not become Buddha, but the issue is that you will retire. What will you do? What is the goal that you want to chase at that point of time? Will you have sufficient money for that?
So, Kamlesh, I heard something very interesting. It was, a myth which you broke for me, that it's not about creating only wealth creation, but to also plan your cash flows. So, can you give some examples how to go about it?
So basically, cash flow is whatever. You're earning so much and you're spending so much, and you want to find whether you are surplus or deficit. All of us build houses, right? We want to apply for a home loan. You can't give your mutual fund statement and say, I have 10 lakh rupees in the mutual fund holding, so give me a 1 crore ka loan.
Sure.
Basically, a 1 crore loan will require you to pay an EMI, give or take, of about 1 lakh a month, for 20 years kind of time frame. So I think people have to understand that when I spoke to you about what is the surplus that is left behind. So if you are earning X, this is the EMI you're paying, this is your cost of running the house, and this is the balance surplus that you're making. That basically is your cash flow.
So what you are saying is that my income minus my all my expenses.
Yes.
I should have sufficient amount.
Yes.
Which is there with me for me to plan something.
For you to plan something, and then part of that you will do for. So when you're creating an asset, okay, I keep telling people that when you're creating an asset, stretch yourself. A lot of people, when they buy the first house of 50 lakh rupees, always have looked for a 75 lakh house, but think that they can't afford it right now. It will put a pressure on. But this is the beauty, that you have to buy that 75 lakh house today.
And
So otherwise you will never buy it.
That's true.
Yeah.
That's true.
So, but if you're buying a car, okay, which is a depreciating asset, then I don't know whether you should. If you buy a 10 lakh car, then please buy a 7 lakh car. And the reason I don't like rent is because rent is, a discipline of what you pay every month, right? The beauty of investing is that you have to create a discipline of setting aside and keep doing something with it every month. 10,000 rupiah you've taken away for rent. You can keep paying rent for 30 years, but that 10,000 rupees has not created an asset for you.
True.
Because the money has gone and nothing has been created out of it. That same 10,000, if you put it as an investment with a SIP or whatever, or EMI for the loan that you're doing, at least you are creating something. And that's the reason I'm not Gen Zs won't like me, but this is my view.
So I was just going to say that you are breaking the entire the Gen Zs and millennials way of living. They want to experience more. They want to buy better cars, and you're saying that obviously car is not a asset; it is more of a depreciating, liability in that sense.
Yeah,
you're really giving them really food for thought.
Therefore, the minimum SIP that runs in the marketplace today is 2,500 rupees. Even if you think you have that much amount of money to spend, start. Because there is nothing like the discipline of having put aside some amount of money every month into an investment that you are creating. And don't worry about how small it is or how large it is. That discipline will make sure you will, keep doing that.
And I remember, Kamlesh, my mother, and coming from a Gujarati family, so we bought the car first before the house, and I was so excited, and I got the firing of my life. And that's where, the old generation, the parents' experience and discipline that you bought something which is not an asset. You bought a car for what, where you don't even have your own house, and I exactly hear you saying. But that brings to another question, and this I'm talking as a woman myself, and for more women out there. For us, when we are planning, one of the things that that women are not being financially literate, because whilst they are earning, they are breaking glass ceilings and all of that we want to, we women feel like, but we still don't take charge of our own finance planning. And in that, we also have another contingencies to plan. Let's say because we are our marriage, the child, birth, where we take a break, or there is any family parental, health issues where the lady of the house will take, leave her job and come because she has to take care of the family. So is there any different, planning or retirement planning that a woman has to do in her lifespan?
So one of the things that we've been trying to do through awareness is to say, even in the term insurance policies, and there are reasonable number of working women as compared to working men. Of course, the ratio is not equal at this point of time, but more men buy term insurance policies to leave behind in case something happens to them for their family.
But isn't the category done this, that they've oversold to men, saying that, and on the fear that, if something happens to you, what are you leaving behind? So keep buying term insurance.
Yeah, I mean, it's got the root of all this is in the way we've projected, how things have been in the past so many years. But today I'm saying both the male member and the female member are working, and that quantum has gone up significantly. Quality of life has become better on account of that. When they take their loans, they are co-borrowers, in the sense both the husband is party to loan to the agreement as well as the wife is party to loan to the agreement.
Yes.
And therefore I'm saying life insurance provides you a great cover in case something happens to you. There are interesting products where you buy life insurance for your loan. And I'm Aditya Birla, we are trying to work hard at this to say the other thing that you spoke about. For a woman, what can we do in a policy that can replace her income during those 2-3 years that she decides to take a break?
Yeah, absolutely.
So that we have realized through a focus group discussion that's the big gap. because she's working, she has a kid. These days women come back pretty fast, but for whatever reason, you want to take a break for the 2 or 3 years time. Is there a way to replace her income for those 2 3 years, which means the income can become continuous? We're still working on it. And through that came another idea to say, why just for women? Because everybody wants to take a sabbatical these days at 1 or 2 points of time in their life. And if there can be a product which can replace the income during the sabbatical, you can be at peace to say, I can afford to take those 2 sabbaticals in my life perhaps. We are working on the product. It's not yet light of day, but I'm hoping we'll be the first people to do that. But starting younger is important.
And interesting for women, I really like the idea, and more power to you and your team if you can create a product and make that industry first. Because women today, being the equal partners, they need that.
Yes.
And I hope the women listening are also taking, at least they're looking at starting and getting in the category. That brings me to another, thinking that the consumers are asking, the listeners want to know that what kind of retirement goals, do they miss? What are the goals and how do they plan for it? So what factors should they consider?
So I think depending on where you start, typically keep in mind if you start at 45 and you get to 60, 15 years inflation at 5% will double the cost of what you are consuming today. So that's a reasonable benchmark to take. Okay, say that India will get to a place of 3.5% inflation over the next 15 years. Then typically what is available today, the cost of that will be 70 or 80% more than when you get to retire. Yeah, so you know exactly your cash flow of today. You know what it is like living a good life. You have to multiply that by a factor of 1.7 to 1.8 to be safe. You multiply it by 2. And that is what you have to then plan for. So say if you're going to live between 60 and 80, that's the kind of income that you need. And for that kind of income, you calculate backwards to say what is the kind of premium that I'll have to pay. And I'm again saying all of it need not come through life insurance. I mean, you could do partly through SIP, partly you think you want to do through equity saving. If you can do it, that's what your goal will turn out to be. For the similar life that you have today, if you want to have between 60 and 80, you will perhaps require double the cost of living as where it is today.
So if we have to simplify this, and if you say somebody who's got 5 lakh rupees income, who's starting out the first job and they are starting at 5 lakh rupees income, what would become their retirement goal? What would that mean? By when?
5 lakh income at what age?
Maybe at 27, 28.
Yeah, so I don't know. If you put the burden of the retirement at that age of 30, then you will not live your 30 to 45 perhaps very well. So I'm saying you got to fast forward it and say at 45, if you reached a particular value of income.
That's if you're earning 30 lakhs.
30 lakh rupees, then you will need 60 lakh rupees when you are 60 for whatever period that you have defined. And then you work backwards and say at 45, if I start, what will allow me to replace that income at that point in time.
So 60 lakhs for your remaining lifespan is how you are saying?
If you require 30 lakhs per year, you will require 60 lakhs per year from the age of 60 till average lifespan of 80-85 years of age.
Wow, I think that's quite an eye-opener for me also, and I'm sure people who are listening. Kamlesh, what are some of the key investment options available for retirement, and how should one decide which one to choose?
Fundamentally, I always tell people, I've been part of wealth management before. I've told people that invest only in those instruments that you understand.
But at every age, is it different? So if I'm starting out at 30 to 40, do I need to look at, some...
So you need to do fundamental risk profiling of your own self, whether you are conservative, whether you are moderate, or whether you are aggressive, and all advisors or today technology tools are able to tell you that, which category that you belong to.
And we at ABSLI will have tools like that.
Yes, yeah. ABSLI will have it, our wealth management will have that tools. So fundamentally, if any advisor, if it is advising a client, he will first assess the risk category of that guy.
Okay.
And then depending on the risk categorization, then he will recommend a set of products. Because we all talk about SIPs.
Yes.
But SIPs can happen in equity, SIP can happen in even debt instruments. So depending on what profile you belong to, I think the investment patterns will change. But at the root of all future earning investment patterns would be systematic investment. So whether you do it in equity, you do it in SIP, you do it in insurance through premiums and so on and so forth. If you're extremely conservative, fixed deposits will come in. I'm sorry I'm saying this, but fixed deposits will come in because you are extremely conservative. You don't understand. You want at every point of time to make sure that principal should not get impacted.
So now that's a good point. You're saying somebody who's conservative, then they should go for those instruments that they understand.
People think, this will make 30% return. No, anything that makes 30% return can make minus 30 also. Otherwise, therefore, there are instruments which make 6% return and people invest in that, right?
Correct.
Otherwise, everybody will be chasing only one category. So if, depending what you look at, for example, for all salaried customers, you should have a contribution to PF and NPS because that you can start early. Typically, what you can start younger, like I said, if you are 30 to a previous question, you do contributions to PF and NPS. And again, the beauty of NPS is the NPS structure is very cost efficient. So the NPS as a category can charge very small amount as fund management charge. It is not more than 5 paisa, 6 paisa charged to the fund. And you have the option to choose whether you want to put your money in debt or equity and so on and so forth. If you look at last 10-year returns or 12-year returns of people who would have put money in NPS with a reasonable contribution to equity of about 40 to 50% would be upwards of 14-15% annualized returns.
So that's very good. So you're talking about the National Pension Scheme,
Yes.
which happens through your HR in your organization, and that's where if you start early, for all the guys who are the first jobbers or mid-career, they should look at NPS is what I hear you say.
The beauty about NPS is when you get the money of NPS, and that's how the structure is, you can take 60% money lump sum. Minimum 40% you have to annuitize.
So what does that mean? So you're saying, first of all, I get this money back post my retirement, right?
Yes.
After 60, I get only
Yes.
60%.
You can draw 60%
Okay.
maximum. Minimum annuitization you have to do is 40%.
What is annuitized?
So basically it means that you have got 100 rupees, you are taking 60 rupees back lump sum. You can change the 60, 40 is minimum to be annuitized. Basically means I'm investing the 40 rupees again to get systematic returns over the next 30, 40 years. So it's again a form of a asset class for retirement, which makes sure you'll have to go to a company, life insurance, or to say any other company that gives the annuitization, but you have invested in lump sum.
So I'm taking 60% back, that 40% again annuitizes, as you're saying, year on year, I will get some
You will
money.
get some return.
Some return. I cannot take that 40, I cannot take 100%.
You cannot take 100%. That's the way the structure is.
Awesome. So NPS, SIP, by the retirement solutions that you all are creating, and that will help us. So at different stage, we have to look at different products. But this is again a myth breaker for me and many listeners over here. Start your NPS early. With your first job, start your planning for your retirement or the long-term income that you. This is really interesting. So not starting at 45, then starting at 25, 27, 30, whenever in NPS.
Yes. But just put the discipline to make sure that, one of the things that we, again, out of focus group discussion that we realized, and you spoke about protections. I'm giving you another example. In protection, we give sum assured.
Correct.
Which means you say, if something happens to me, I want my dependent to get 1 crore. Yeah? The problem with that 1 crore is, it's a lump sum amount of money. Again, my philosophy between cash flow and wealth. Yeah? So 1 crore suddenly becomes wealth. When you get 1 crore, I don't know how everybody around you comes to know that you've got 1 crore. Yeah? And then all the unwanted advisors come to you and say, do this with this and do this with this. And maybe if you put right now, it will double in 2 years or 3 years kind of time frame. And a lot of mistakes happen at that point of time. And it goes to perhaps a dependent member. And if he or she is not earning or not as well educated, then mistakes can happen. We found that myth, and we just, as I speak to you, launched a product which has gone live on the Policy Bazaar counter. We say, don't buy sum assured. Buy income. We call it the Income Suraksha product. Okay, which basically we are saying, if something happens to you, tell me how much income you want your family to have for the next 10 years or 15 years time frame.
Okay.
So it's a sum assured invested well which gets converted. So it's mathematical. But you can buy and say, I want 30 lakh rupees to go to my family for the next 10 years kind of time frame. So we've created a variant of protection right now, and we are the first in that category to do that. It's doing pretty well. We just launched it about 15 days back. We call it protection, but we call it Income Suraksha protection and not sum assured protection.
So not taking the whole amount, but you're taking planning. The family gets it as an income.
Income every year for whatever period that you can want design or define and so on and so forth.
That's nice. I think that's really interesting. People should go out and check the Aditya Birla Sun Life's this protection
Income
Suraksha product also. But you bought in another good important person in this whole scheme of thing is called the advisor. And I want you to tell our listeners that when you are looking for all these retirement planning solutions, and what should they look in for a good advisor?
I keep saying this. I'm a firm believer to say advisor brings you choice. He can't bring you a product category which you don't understand and you say, oh, this could make large amount of return and therefore you entrust the money there. Because you need to understand that if that is going to go up, it can also go down. So as long as you're conscious about that, I think advisors play a very great role, whether they are individuals, IFAs, companies, banks, for that matter. But also today, there are a lot of technology platforms.
Correct.
Which can help you understand what you want to do. Make use of that because information today is available free. So
all the fintech platforms.
Lot of fintech platforms, lot of advisory platforms. There are platforms in which you can put your holding statement and out will come a report which will tell you whether based on your risk profile you are doing the right investments or not doing the right investments. But your own awareness about what you are investing in, I think, is important. And then advisory doesn't hurt at all.
So then it's important point that you're making that the advisors, first thing first, whatever they bring in, read, be aware, and the choice should be with you.
Yes.
You have to be empowered and don't blindly follow wherever they are telling you to. Please read, please be aware.
Yes.
So that's a very interesting facet. And Kamlesh, with this, now we've had a serious conversation, but now let's have some fun. We are going to do a quick thumbs up, thumbs down, and let's see what, because we'll sort of have a little bit of rapid fire. So it's a thumbs up, thumbs down, and I'm going to ask you questions around what are the good methods, what are the good ways to plan your retirement, and let's see if these statements, I'm going to make some statements, and you tell me that's thumbs up, the audience should be doing it, or it's a no-no. The first statement is setting up automatic contributions to retirement accounts.
Thumbs up.
Relying solely on inheritance for retirement.
Thumbs down.
Investing in a diverse portfolio.
Thumbs up. Broadly thumbs up. Yeah.
Do you want to throw a little more light on what is diversification?
Diverse within your risk profile. I'm just saying diverse is fine. Because if you are conservative, you'll get a choice on FD, you'll get a choice on PF, you'll get a choice on something else. So diversification is absolutely important. And diversification also means एक bank में fixed deposit नहीं है, other people are there, or you between bank and you do non-bank. So spreading X amount of money also is a great idea. But like I said, within the gamut of your risk profile.
Ignoring healthcare costs in retirement planning.
Absolute thumbs down.
Starting to save early in your career.
Thumbs up. Absolute thumbs up.
Keeping debt levels low or paying off the debt before retirement.
Debt levels are always good. Again, if you, I have been a firm believer that always have some debt, but have a debt for an asset that is going to appreciate. Yeah? Home loan is a debt.
Correct.
Yeah? And you put pressure on yourself to get a home loan and then pay it off. So that is fine. So if you are doing something, making some money, paying off, because home loan interest rates can be different depending on interest rate cycles, right? So if there is a high cost debt that you are replacing, often something that for which you are creating an asset, then I'm saying always absolutely okay at definite points of time.
Assuming that expenses will drastically decrease in retirement.
Thumbs down.
Regularly reviewing and adjusting your retirement plan.
If you define the frequency, it's a thumbs up. Don't do it too quick, too fast. Okay, if you do it over a yearly basis, is good enough.
Relying on one source of income in retirement.
It's a tough one because all that you would have planned for will come to you in retirement as one source. But make sure that you planned for, I mean, the funnel is different sources and they all have culminated at 60 to give you a source of income post your retirement. So don't invest in one source between 45 and 60. But if all of that accumulates and then gives you a stream of income as one income, then I'm saying it's absolutely fine.
Postponing retirement savings to pay for children's education or any other such life key, expenses.
Uh, a reasonable thumbs down, because the more you postpone, the more difficult it will be for you to make that dream a reality.
And with that, Kamlesh, an excellent learning for me also, and I'm sure the viewers have enjoyed. And thank you for your time today.
It was happy. I'm happy to be here, and it was good talking to you.
And with that, thank you very much for all of you out there listening to this episode. And thank you, Kamlesh, for being here and giving us so much of insights, breaking the myths. And really, I think the impact is please start being disciplined about your finance and retirement planning. So thank you. We hope Kamlesh's insights have brought you one step closer to planning your secure retirement. And remember, it's never too early or too late to take control of your future. Catch this episode on our YouTube channel, Spotify, or your favorite podcast platform.